Hello, everyone. I want to thank the Share Series Conference so much for having me out here today. My name is Julianna Paterra. I'm Vice President of Investor Relations at Verano. We are a Chicago-based U.S. cannabis company listed on the Canadian Securities Exchange under VRNO and the OTC under VRNOF. So, of course, the fun forward-looking statements, non-GAAP financial measures, and into the good stuff. So I'm going to begin today with a broad overview of the U.S. cannabis market before diving into Verano specifically. So as you may have hopefully just caught earlier, we are listed on the Canadian Securities Exchange, though all of our operations are in the U.S. So there's a reason for that, given the federal illegality of our industry. As it currently stands, we cannot list under a U.S. exchange. However, you may be familiar with some other names, such as Tilray, Canopy. Those are able to list on U.S. exchanges. However, those are Canadian operators only, which notably is a much smaller market than the U.S. as a whole. So there's a lot of growth here and runway ahead of the industry here in the U.S. We put up $27 billion, the legal market in the U.S. in 2022, projected to put up $42 billion in 2026. There are many new states that are continually legalizing programs. So actually just recently, Kentucky last month became the 38th state to pass its legal medical program. So really long gone are those days of the stereotypes of very liberal West Coast states only having legal programs. We're now approaching 20 adult use markets in the US as well. There's opportunity with organic consumer uptake. So as consumers in their markets honestly just realize that there's even legal product available. Candidly, I didn't know my home state of Illinois had a legal product market until I started at Verano about 2 years ago. So we're very limited in the industry in what we can do marketing-wise. So a lot of this is really word of mouth and organic uptake of consumers. As consumers sometimes replace alcohol, tobacco, even opioids with cannabis, that's future opportunity. And as we absorb consumers from the black market, as they begin to realize really the value add here that the legal market offers, which is consistent, tested, and trustworthy and safe products. So as you may imagine, working in a federal illegal industry brings with it some challenges. So we feel, we're really overshadowed by this lack of federal legalization. As I mentioned, we are on the Canadian Securities Exchange. All U.S. operators at this point have to be listed on a Canadian exchange. What that means is that we are not included in any indices. We're heavily retail traded, and we have very limited access to institutional investors. We believe this has led to depressed multiples for our industry. The top 5 cannabis via sales in the U.S., the top 5 operators put up one including Consensus that has not yet reported 2022 numbers, but nearly $5.5 billion in revenue. Those same 5 operators are projected to put up nearly $6 billion in revenue for 2023, yet the cumulative market cap of those 5 operators is only around $8.4 billion. We additionally must work under the 280E tax rule, which essentially means we are taxed at the gross profit line. And additionally, we have to have all of our operations state-specific. So Verano, we have active operations in 13 states. It's as if we work in 13 different countries because every state is going to have its own very specific program with rules, regulations, et cetera. However, it's not all doom and gloom. We've seen some very promising progress. So on the federal front, just last October, the White House announced some sweeping reforms. So those with simple cannabis possession offenses were pardoned. The president issued a directive towards the HHS and the Attorney General to reevaluate cannabis's Schedule I drug classification. For those of you less familiar, Schedule I is kind of the toughest, the highest, the hardest. We're up there with heroin. Schedule II is down there with like fentanyl and meth. And Schedule III, which we believe if we could get down to a Schedule III classification, that could possibly open pathways to a U.S. listing. Schedule III would be around with like a Vicodin type drug. So we're also seeing bipartisan support as well for the Safe Banking Act, which would broadly open our banking access and we believe decrease our cost of capital. And then we focus more on the state level. So we think we can make a little more of an impact working with our state legislators in states that we already operate, working towards structuring adult use programs. Typically, adult use program will follow a legal medical program. So if we have medical operations in that state, working with local legislators to ensure that they're building a framework that is setting the industry up for long-term viability, or even working at a state level to address the 280E tax implications. So we've recently seen some success there in New Jersey. Their state Senate just passed a bill to remove the 280E tax rule, and now that sits on the governor's desk. So something like that, if that passes, that's an immediate bump to our bottom line. So we're really excited about some of these progressive moves that we're seeing for the industry. Okay, so on to Verano specifically. Got some typical stats up here. So we've got 126 dispensaries across the U.S. We employ almost 4,000 people in our facilities. We have over 1 million square feet of cultivation. We have plans to open more dispensaries throughout this year, generally around 140 is our target, and we have active operations in 13 states. So this is our geographic footprint. This was extremely strategic and methodically thought out as to where we enter markets and operate. We target limited license states with the goal to go vertical in them, which means both cultivating and selling in our dispensaries. Limited license state is kind of what it sounds like. So I joke that we're one of the few industries that actually encourage much more heavy state regulation. Limited license state, take Illinois, for example. Cultivators, operators are capped on cultivation and can only have up to 10 dispensaries max. So you'll see we have our max of 10 dispensaries in that state. Right now, that state only has about 120 dispensaries with some more that we believe will be handed out to social equity entrepreneurs. However, the state is doing that methodically and strategically in a phased process. You kind of take California as maybe an example of the opposite. We're great out here. We have a stake in a pesticide remediation business, but we have no plant touching operations there by design. That state candidly has let the gray and black market really overrun the state. So you've seen an incredible oversupply, a really hard hit on pricing pressures, pushing downwards. Hundreds and hundreds of stores and dispensaries that are operating without a license. Consumers would never know. You walk in, it feels very legitimate, but they have no license, and the state does nothing to regulate it. So we strategically target states that we think we can have strong relationships with the state and just a better state to operate in, candidly. Okay, so Verano specific growth drivers, we essentially target high quality products, and across the spectrum, we want to have products for all types of consumers and all types of needs. So we've got edibles, flowers, medical design products such as lotions and tinctures. We have scaled operations in 5 states that we see as having potential to flip to adult use in the near term. One is Connecticut, which just launched its adult use program in January of this year. Maryland, we believe, will open second half of this year. And then Pennsylvania, Ohio, and Florida, we believe, has a possibility to pass adult use legislation within the next couple of years. And our goal is to build a strong presence once the state is a medical-only market. We want to understand the market, build some brand awareness, really ramp up operations and have a strong presence so that once a state passes adult use legislation, we are ready to go, ready to meet that increased demand, which we typically see as anywhere from 2 to 4 or 5x versus medical-only sales. And currently in the environment, what we're seeing, obviously every industry has inflation and, recessionary pressures behind it, but the cannabis industry specifically has seen in certain markets pricing pressure due to some oversupply. So we're seeing that alongside with the very onerous, as I mentioned, 280E tax structure. So we're seeing some smaller operators start to show cracks and, some even going under. Verano, we feel very strongly positioned right now. We have a, broad footprint, geographic footprint. We think this has given us a diversified approach that we're I don't want to say immune to any pressures. We certainly have pricing pressures in some of our markets, but given our diversification, we feel very strong right now. And we actually see this as an opportunity to find really attractive acquisition opportunities at really attractive multiples. I want to clarify, we're not interested in bargain basement diving right now. We want strong operators. We want really polished operations at the cultivation and the dispensary side. But even so, we think we can find really strong operators to partner with at really attractive multiples, just given some of these industry dynamics right now. So a little on our brands. I'll kind of start up at the top and move clockwise. So we have our namesake Verano. So this is heavily flower and smokable products. Notably, it's per BDSA, which tracks data for the industry. It was the number five brand in the entire U.S. and number one brand in New Jersey, which is quite a large market for the U.S. Moving counterclockwise, Move is our Florida brand. We have very strong presence in Florida with 66 dispensaries out of our 126. Florida is a little unique in that it is 100% vertical. So you can only sell in your dispensaries your own brands. So as you can imagine, it's quite a margin uptick by operating in Florida. And we see that as a very strong market moving forward should that pass adult use legislation. Savvy is our fairly new, we launched last fall, value brand. So given some inflationary pressures that the consumer is facing, we made the decision to launch a more value priced brand for consumers. We've seen very strong uptick in that as well. Bits was also a new brand that we launched last year, really due to some new consumer insights. So it's a lower dose edible line paired with adaptogens such as rosehip or elderberry. And keeping the clockwise going, we've got Avexia there. That's our medical-based line, so a lot more of the balms, lotions, tinctures. And up at the top is our legacy Encore edible line. So that's got everything from caramels to mints to chocolates to gummies. And a little on our retail brands. So we have Zenleaf, which is our main U.S. branded dispensary across the country. So this is going to house the majority of our locations. And additionally, we have Move, which is our Florida dispensary brand, largely due to the acquisition we acquired in Florida. It already had a strong brand presence, so we have maintained that store brand down in Florida. And going over some financial highlights. So we had a record 2022. We saw 19% revenue growth year over year with $879 million. We had a strong year for investing in growth. So we opened 21 dispensaries. Most of those were in Florida, some in Nevada and Pennsylvania and West Virginia. And we expanded our cultivation presence in New Jersey as New Jersey launched their adult use program spring of last year. And that's been a very strong market for us, and also increased our capacity in Florida, again, as we're adding stores and also hoping adult use legislation may pass in the next 2 years or so. We've got strong margins. We posted 37% adjusted EBITDA margins for 2022. Our vertical strategy allows us to capture additional margin there, and additionally, we've been prioritizing our in-house brands in dispensaries to increase sell-through, which again is additional margin capture. So at fourth quarter of 22, we increased sell-through of our brands to 47%. And as I mentioned earlier, we launched 2 new brands, really driven by consumer insights. So we continue to R&D and expect additional brand launches in 2023 and possibly 2024. And a little bit more on our margin profile. So for the industry in 2022, for those of our peers that have reported 2022 numbers, which is nearly all of them, we have the highest numbers on adjusted EBITDA for 2022. So it's something we prioritize as a company. We're very margin focused, and we hope to continue to deliver one of the top margins in the industry. Little on financial results. So I've spoken to both cultivation and retail. We seek a balanced approach here. We never want to be too overly reliant on any wholesaler, and vice versa. We don't want to be too overly reliant on any string of retailers. So we want a balanced approach in our markets. We had like I said, $879 million in revenue for the full year of 2022, and just about $324 million in adjusted EBITDA dollars. We had a net loss of 269 for the year. However, that was largely driven by 229 million of impairments in the fourth quarter on certain assets in Arizona and Pennsylvania. Fourth quarter results, we posted about 226 million in revenue, and again, we had the impairment in fourth quarter, which drove the loss for that quarter and for the full year. We have a focus on the balance sheet at the moment, just given some of the recessionary pressures that we see coming. So we refinanced our debt last fall, extended that maturity out into October 2026. We added some prepayment flexibility terms into that, and we ended the year with about 85 million in cash. And on near-term growth drivers, we are building on momentum for 2023. So this year alone, we have a portfolio consists of 2 states that we anticipate opening adult use sales. So Connecticut already opened on January 10th. So far, that's done really well. We have our 2 dispensaries there and an extremely strong wholesale presence. We believe we're the top, if not one of the top wholesalers in that state. And additionally, the way that state is set up, we have the ability to partner with 6 social equity entrepreneurs in that state and create joint ventures. So we're going to be able to add 6 joint venture partnerships onto the balance sheet or the P&L once we open those up. And for Maryland, we anticipate that state opening in the second half of this year. We've had a presence in there since the early days of the medical market. We have our cap of 4 dispensaries in that state, strong cultivation operations. We've increased sequentially 6% our wholesale sales for the fourth quarter. And as of January, we had about a 10% market share in that state. So we're excited about things to come in Maryland. And again, 2023, we're really focusing on the balance sheet, cash preservation, just given some of these industry dynamics. So 2021, 2022 were very heavy investment years. 21 was very acquisitive. In 2022, we continued heavy CapEx investment as we really want to make sure we are invested well ahead of growth. So in 2022, we had 119 million in CapEx dollars spent. And in 2023, we're guiding to only 25 to 50 million in CapEx as we feel that we are appropriately supplied at this time in our markets. Additionally, we had 117 million in cash go out the door for largely earnouts related to acquisitions. And then this year, we only anticipate about 16 million going out. And we leveraged our real estate last year for around mid-single digits in mortgages. And this is a unique identifier of Verano versus peers. So we are really the only operator that has not entered sale leasebacks. And this was very strategic, very by design. The sale leasebacks in our industry are quite high rates. You're going to be tied down to your real estate for probably 20 years. And we want the flexibility should interstate commerce pass, which would mean products could now cross state lines. We don't necessarily have to grow everything in Illinois that we sell in Illinois. Perhaps we have a hub and ship from there. So we want to own our real estate so that we can have that flexibility to walk away should that be folded into any federal legislation that should pass, whereas our peers are tied into sale leasebacks. And of course, exploring cost-saving initiatives to continue to preserve the margins where we can. And so all of this is culminating to our free cash flow guide for the year. Again, 21, 22 were heavy investment years, and we wanted to make sure we were appropriately invested well ahead of growth. And we feel like we are very well able to supply the markets, given the current environment and even with some future growth. So, this kind of led to our free cash flow guide of 50 to 75 million for the year. And, we're really excited about things to come. And I'll kind of move on to any questions that we have.
Yeah, a couple of questions. Number one, 230 million of impairment of assets, that's a very big number. And given the age of the assets or the lengths of the company, that they must have been fairly new. So can you tell me what happened there That's number one. Number two, I'm curious about New Jersey. You didn't mention as a big growth item for 2023, but we're seeing a lot of new dispensaries being approved in New Jersey. And while you only have 3 dispensaries of your own, I imagine that you would be targeting all the others for your cultivation product.
Great questions. So with the impairments, yes, those were some recently acquired assets. They were for Arizona cultivation license and some Pennsylvania and Arizona retail operations, which were acquired, to your point, not too long ago. However, more at the height of the market on some pricing. So given pricing supply in Pennsylvania pricing pressure due to oversupply in Pennsylvania and Arizona, that led to a devaluation of those licenses and assets. So that led to those write-downs. New Jersey, still a very strong market for us and a growth driver for 23. However, 2022 had I would say the majority of 2022 had New Jersey sales in it. So, as a comp on 2023, it's not necessarily going to be a huge year-over-year comp as sales open again. It was late April of 2022. So the majority of the year has had New Jersey sales in it. They have issued a lot of new licenses, or I should say are trying. What we're seeing is that it's very hard for some of these license winners to find approved zoning for their dispensaries. So very few have opened. Additional stores have opened to date. We anticipate maybe a few dozen open through the year. But as that state, to your point, that had very few dispensaries to begin with. It was around a dozen to serve the whole, state of New Jersey. We're very excited as that is a wholesaling opportunity because we had very strong wholesaling operations in that state. So we're welcoming new store openings in that state, but just given a lot of the municipality restrictions, it's just taking a lot of time for those new stores to open.
So quick question on consumer. And so obviously we've heard a lot from companies today on the health of the consumer. You guys are obviously preparing for a storm, your words. So what does that look like? Are you already seeing something from the consumer? Are you seeing them trade down and basket ticket?
Yeah. So we're seeing nothing, I would say nothing unlike other industries, which is slight basket size decreases, really step in line with sequential inflation growth. So slight basket size decreases, and we were seeing a bigger desire for value products. So that's why we had been designing a value brand in 21, early 2022, and we decided to pull forward the launch of that value brand in summer and fall of 2022. So that has allowed us to capture some of those consumers that were perhaps feeling the pinch a bit more. Medical states tend to be much stickier in sales, so we haven't seen much movement there, but the consumer on the adult use side is starting to gravitate towards more value branded and just slightly pressured basket sizes.
Thank you.
Yeah.
You mentioned California as a bad example, but you made no mention of 2 other very large states. And I'm just curious as to why you're not there. Colorado and Washington State. Was it a similar story as California, or what was going on there?
Exactly how you put it. Similar story there. We're starting to see some more consolidation in Colorado, so it could possibly be of interest to us a little more in the future, maybe after some additional consolidation. But for states like that, you'd have to plow millions and millions of dollars into operations there to barely move the needle in market share. I'm talking like basis points. I think the top California brand has 1% or 2% of market share. And candidly, even New York is another example. Unfortunately, it looks like that's going to have to go through the same cycle as California. There's a lot of the gray market here. We're seeing a lot of that go unchecked. So hopefully that changes and it doesn't quite become a California story. But no, exactly to your point, there's a handful of states that we've seen go through that cycle that we prefer to avoid.
So I'll ask one final question. It actually came in earlier from the audience, and you already kind of alluded to it. But can you describe a little bit more about what's going on here in New York? Right, because I think they passed adult recreation, but
Yep.
there's no dispensaries.
Yes. So I believe the first, and we don't have any operations in New York, just to clarify, but I believe the first dispensary opened around Christmas time this past year. The state has had that adult use program passed for a little bit of time, but it took a little while to get off the ground and actually get, operational. We've seen, a very, very, very slow rollout in those legal stores opening. But I imagine if you walk out the door and walk down the street, you'd very quickly pass signage for, cannabis, pre-rolls, lollipops, infused, what have you. And that seems to all be going very unchecked at the moment, which is concerning just from a consumer safety standpoint, because you just don't know what's in there. And it's being sold under the premise that this is a safe, tested product, not from the black market, and it's actually a bit of the opposite. So New York's interesting. We're keeping an eye on it just to see how it plays out, because it's so nascent. But yeah, so far it's taking quite some time for those legal dispensaries to open. I think at this point, I know it's more than one. I want to say we're at a handful now that have legally opened, but it's been a little bit of a slow path for New York. Yeah, absolutely. Well, I know we're heading down to the closing bell ceremony, so I don't want to hold us back any further, but I want to thank the Share Series here for hosting us today, and thank you for having me. So appreciate it.